Hey traders, welcome back to the weekly Forex Forecast. The biggest cross-asset rally this year takes Wall Street by storm. This is the Bloomberg headline we're waking up to this morning. And I'm going to show you in today's video why those buying stocks are most likely running into a massive bull trap heading into next week, and why the moves that we're seeing in the Forex markets are consistent with pre-crisis liquidation moves, and that we could actually see quite severe downside in stocks in the next couple of weeks. Okay, so looking at the scorecards for the coming week, you can see the dollar is at the top of the scorecard. However, it has a red arrow next to it. This means in all probability, we should be expecting a pause or a reversal in the dollar near term. And in fact, we had that throughout last week and we did get the big sell-off in the DXY on Friday. Now, as I'm going to show you in today's video, there is quite a lot of evidence to suggest what we're seeing in the dollar is in fact part of a pre-crisis liquidation. It's exactly what you would expect to see if there was a major risk-off event coming in stocks. And I know that's hard to get your head around if you've been looking at the price action and the tape over the last week or so, because we had a huge rally in stocks. But I'm going to put that into perspective for you and show you where I think the bull trap is in equities next week. So I'm going to be doing something in today's video which I haven't done before, which is I am going to consider US dollar shorts next week, despite the fact it is in the positive side of the scorecards, because what's happening now in the markets, I can assure you, based on the volatility of moves, is not normal. So aside from US dollar shorts, which again, I'm going to show you why I'm looking at those this week in a minute, I do like Canadian dollar shorts. I do not want to trade the yen short because the yen is a risk-off currency. It's the most risk-off currency. And at any point, if we are going to get risk-off in equities, the yen can catch a bid, and I do not want to be on the wrong side of that short covering rally because that could be quite severe considering the major sell-off we've had in the yen. So going into next week is very, very tricky to structure trades. Again, I favor short Canadian dollar because this is the second best short in the scorecards. I also am going to be looking at short US dollars, and I'm going to be primarily pairing those versus the euro, the Aussie, and the pound. This week I tweeted out that the 12 trading days following Wednesday's FOMC meeting are likely going to be the highest risk period for the stock market. And this is also going to have an effect on the Forex markets, which is why we're discussing it in today's video. So it's very important we understand what's happening in stocks. So why did I say this? Why do I think the 12 trading days following Wednesday's FOMC are the highest risk period for the stock market? And I know we rallied, and we're going to look at the stock market in a minute, but the first thing to understand is the economic cycle that we're in. Everybody knows that the cycle is late stage, that we are coming towards the end of the cycle and we're going to get a recession, not just in the US, but globally. But the debate is when this is going to take place. And we saw huge amounts of buying coming into the stock market last week on the basis that yields have essentially peaked, the yield curve has bottomed, and we're about to uninvert in the yield curve and re-steepen for a period of time. And this is going to usher in a Goldilocks period where stocks rally, just as we saw in previous cycles. And in fact, you can see in the previous 4 cycles, we had the yield curve uninverting first, and then a recession hit a period of time after. And what tends to happen, especially over the last 4 cycles, is you get the uninversion of the yield curve continues to steepen, the Federal Reserve cut interest rates as the economy starts to slow, and very often about a year after the first cut, you start to see a recession take hold. And this is the bullish mindset that has taken over the stock market last week. People are buying stocks because yields have peaked, the yield curve has bottomed and is about to uninvert, and as a result, the idea is that we're going to go into a Goldilocks period for stocks. The problem is we've just been in an inflationary cycle. This is not the same as the previous 4 cycles. And the last 2 inflationary cycles came in 1980 and 1981/2. And you can see those recessions both kicked in with the yield curve still inverted. And you can see in the current cycle, we are very, very close to uninverting in the yield curve. We're right in the same area we were when a recession hit in the inflationary cycle of 1980 and 1981-82. And it wasn't just a recession which hit with the yield curve still inverted during those inflationary cycles, because we had inflation at over 7.5% in those cycles just like this time. We did not see that in the previous 4 cycles. And my view is that many traders could be suffering from recency bias, where they're looking back on prior cycles or the last 4 cycles, and they're forgetting that we did not have an inflation problem in those cycles. They were not inflationary cycles. And therefore, the rate of change in interest rates going up is not comparable in the last 4 cycles as it currently is. And in fact, it's more comparable to 80, 81, 82. And there are many reasons which we're not going to go into today's video because it will make the video too long, but we've been tracking those cycles very closely. So that's the first thing to understand in terms of the cycle. We're late stage. We are now about to uninvert in the cycle. And in the previous 4 cycles, which weren't inflationary, we did see a Goldilocks period where we saw stocks rally. And then we had the recession, about a year after the first rate cut. And this is why people are buying stocks. But it's important to remember that in the prior inflationary cycles, this was not the case. And in 1980, we saw the stock market selling off about 20%, coincident with, in other words, at the same time that rates peaked. And this is exactly what we've seen this week. And in 1981 to 82, we also saw a recession and a market crash coincident with rates peaking. We did not get the Goldilocks period. We did not see stocks rallying as the Federal Reserve began to cut rates to ease a slowing economy. They cannot do that this time because of inflation, and this was exactly the same case back in 80 and 81, 82. So the second thing that concerns me then is the dollar itself. Now, why does the dollar concern me? Well, we've just established that in inflationary cycles, historically, we've seen something break with the yield curve still inverted or uninverted. And that's because rates are held high. And I think we're very analogous in this cycle to 82, the 81, 82. And it's because rates get held high until something breaks. The Federal Reserve doesn't have the room to cut rates early, which is when you get the steepening usually and the Goldilocks period. So now we've established in the cycle we're in a high risk period for an inflationary cycle. What would we expect to see if we were about to get an imminent risk off event in the stock market? Well, one of the first things you should be looking for is a liquidation event. First and foremost in the dollar. And over the last 2 days, especially, we gapped down, as you can see over here. We've had a very strong sell-off in the dollar, and we've seen the dollar selling off on Friday 1%. Now you can see just by eyeing off on the chart here, this is much bigger than you would normally expect. However, I can tell you that historically, 0.8% down days to 1% down days are the type of moves you see in the US dollar in liquidation events pre-crisis. We see exactly the same in the 82 scenario that I do think we are analogous to in this cycle, where the dollar sold off 7%. At the same time as the stock market crashed. In fact, they moved down at the same time initially, then the dollar bottomed on a flight to safety around November, and stocks continued to crash all the way into 82 the following year. This is exactly what we saw, for example, before 08, when we saw a 5% sell-off in the dollar, and very often pre-crisis liquidations are usually around 5% or more in the dollar. We saw this in 08, and we also saw this in 2020. We had this pre-crisis liquidation event before the dollar caught a bid, and of course, this was when we saw stocks start to deteriorate in all of those circumstances. The other thing to note is, as we sold off in the dollar, we had this big liquidation. What did we see in gold? We saw gold finish the week lower. So gold also got liquidated last week as we started to see this and as stocks rally. And yes, we have seen stocks rally, and we're going to look at stocks next. But if this liquidation continues, and this is something to look out for over the next couple of weeks as a potential confirmation of what I'm saying in this video, if we continue to see the dollar liquidate as we started to already see, so it's just a continuation of this, first and foremost, 5% would take us down to the 102 in fairly short order. These 5% liquidations happen fairly quickly. So this will be one of the signs to look out for in the coming weeks. If this materializes, this is going to add weight to the idea that we're entering into a potential sell-off in the near term in stocks. And I'll show you exactly on the chart where I think that bull trap is going to be. And it's why going into this week, based on where we are in the cycle and also what I'm going to show you in stocks now, and this liquidation at the same time gold sold off, that is the concern I have going into this week, and it's why I am interested in potential dollar shorts, despite the fact they're at the top of the scorecards and peaking. So the third and final thing I want to show you in today's video, because there is quite a lot of other data, but it's too much to put in today's video, but I want to show you the stock market itself, and I want to show you how the technicals align with everything else we've just discussed, i.e. we're late stage in the cycle, we're at the point where historically in inflationary cycles something breaks, and we're starting to see liquidation in the dollar. And by the way, we also saw on Friday not just a 1% down day in the dollar, and also, of course, last week gold didn't perform despite this sell-off in the dollar. But we also saw what's called a bull steepening in the bond market. It's where the short end of the yield curve actually falls faster than the long end. We saw this on Friday. At the same time, the dollar index liquidated about 1%. This is exactly what we saw after the FOMC meeting in 1982, which preceded the stock market sell-off of about 28%. And interestingly, were we to get about a 28% sell-off this time, it would actually take us back down to the October lows. So if we have a look at the stock market itself, and I'm not a massive wave fan, I'm not a huge Elliott waver because I don't believe the markets are moving on waves all the time. However, waves do appear in the markets, and when they jump out at you, they should be clear. And there is actually quite a clear wave count here setting up in the stock market itself. And what you can see here is back at the peak of the bull market of 2022, where we ended and we got the bear market of 2022, the first 5 waves down finished with a massive rally off the lows. And what we also saw, where you can see the V and the 1, which is in gold, we also saw off that low very, very bearish sentiment. In fact, we saw in the AAII sentiment survey, at the time we bottomed, after the first 5 waves down at the peak of the January bear market, we saw the AAII reading of above 50%. And what I said at the time was, when you see these AAII sentiment readings of 50% or more to the bearish side, this is very often, especially at the top or a market peak, the data shows this is often confirmation of a bigger risk-off event unfolding. And I put this out on Twitter at the start of the bear market in 2022, to say we've just had a 50% reading. Yes, we've bounced off the lows, and we bounced quite violently. But this very often historically confirms risk-off incoming. It's not a contrarian indicator when you get extreme readings in the sentiment survey of 50% or more. So based on the sentiment data, that is a data point which also confirms that the first 5 waves down we've just seen in the stock market are actually the start of a bigger risk-off move. Now, it's not guaranteed, but that is when you see 50% bearish readings off of market peaks. It's when you're seeing a big risk-off event unfolding. And remember, this is a separate data point to the other things we've discussed in today's video. So we had this rally, but if you look at this rally that we had off the recent low, which again came off of a 50% bearish reading in the AAII sentiment survey. So not unexpected at all. When bearish sentiment gets very extreme, you get severe market bounces, especially in a downtrend. And if you look at the rally we've had, it was a 6.58% rally off the lows. This is the rally everybody is going crazy over as being extremely bullish. It is just half, it's just about made half of the rally we saw off of the January-February lows at the start of the 2022 bear market. So if you're just looking at the S&P 500 and saying, because it's gone up 6.58%, this is the start of a big move up, this is not even comparable to the bounce that we saw at the beginning of the bear market in January and February. So you need to have some perspective on the technical side of this, because it is not, historically speaking, a massive move that we saw. Yes, it was sharp. Yes, it was violent. Yes, it was vertical. But if you put it into perspective, this is not, as it currently stands, anything that would technically shift the recent sell-off in the stock market. And in fact, as you can see, we're mirroring the 5 waves down we saw at the start of the 2022 bear market into a 50% bearish reading of the AAII sentiment survey, which of course causes a big bear market rally. And if we're going to go into next week, where do I think we're likely to see, if we're going to get a bull trap, which I think based on everything we've discussed is very possible, where do I think that bull trap could be? Well, I've highlighted it in blue for you. That is the area, as you can see, it mirrors as well the second wave where we started the third wave in the 2022 bear market and where we ended the second wave. It mirrors that exactly, where we had the 5 waves down, the extreme bearish sentiment which caused a sharp rally. We then take out the high of the 4th wave, and what that does is on that breakout that sucks in all the bulls. That's where the trap tends to be technically when you get the start of these bigger moves down. So again, there is no guarantee in trading. I've outlined the cycle, the red flags, the canary in the coal mines that we're seeing in the bond market, in the dollar liquidation. And now I've highlighted for you not just how we're mirroring the 5 waves down technically, the start of the 2022 bear market, but also how we've bounced out of extreme sentiment, which was confirming a further downside in 2022, and how the rally we've actually seen is not even really comparable to what we saw in January and February of 2022 when the stock market continued to roll over. So there's nothing we can say right now based on the price action last week that is in any way confirming the overall risk-off period has finished, that we are starting a new bull market, and that the yield curve uninversion that we're seeing isn't going to be the same as prior inflationary cycles. Okay, so let's have a look at the best markets heading into this week that I'm looking at in Forex. I do like crude oil to the downside. The only problem with crude oil is if there is any escalation in the Middle East, we could see a spike. So I do like shorts on balance, but just beware if you are shorting crude oil, you have that risk. So any pullback in crude oil next week is viewed as the opportunity to look for bearish breakouts intra-week as we start to get lower global demand, as we see a slowdown in the Eurozone, which is most likely in recession, manufacturing in China contracting, manufacturing in the US contracting, we see demand go down for crude oil. So any breakout to the downside is viewed as the opportunity to look for a sell-off into the 77 area. Or if we continue to pull back all the way into the 86, perhaps test these highs over here, this would be the area to look for a near-term short in crude oil. Again, bear in mind the risks around shorting crude oil with the ongoing conflict in the Middle East. Moving on to the Forex pairs, starting with the CAD pairs. Now, based on everything I've just discussed, this is why I'm interested in US dollar shorts, because if we are going to get continued liquidation, if we are going to get a bull trap in equities and we're going to see further downside in towards the end of the year, even though everybody is kind of expecting a Santa Claus rally, if we start to see stocks deteriorating in the next couple of weeks, then of course that liquidation is going to see further downside in the dollar. I highlighted how it normally sells off about 5%. So they're not my favorite opportunities next week, although to be honest, Forex in general is hard to trade in these conditions. I prefer the CAD pairs because even if we don't get continued liquidation in the dollar, let's say everything we've discussed for whatever reason doesn't play out, although I do think actually there's a good chance of it happening that way, then the Canadian pairs are actually bearish in the scorecards anyway. So any pullback in pound CAD next week is viewed as the opportunity to look for an intra-week breakout into the 1.7075 area, you could say. And if we continue to pull all the way back and we test the prior low over here right in the 1.6750, this would be the second place to look for a near-term long opportunity next week in pound CAD. Next is Aussie CAD. We've got really nice momentum. We're starting to consolidate. So any pullback is viewed as the opportunity to look for an intra-week breakout. I like to use the 1 hours into the 0.89850. That's the opportunity breakout intra-week in the 1 hour into the 89850. Or if we pull back and we retest the 0.8800 area, this is the second place next week I'd be looking for a near-term long opportunity in Aussie CAD. The final CAD pair is New Zealand CAD. We also have strong momentum here, and so any pullback next week, I'm looking for this to consolidate, and I'm looking for an intra-week breakout to the upside into the 0.8280. And again, if we consolidate and we pull back, and I like it when we've got prior lows sitting right in these zones. If we pull back into this zone and test this low, it's the second place next week you can look for a short-term buying opportunity in New Zealand CAD. Moving on to the dollar pairs, we've got strong momentum because we've started to see the dollar liquidate. Is it going to continue? This is the big question. This is what we need to look out for over the next 2 weeks. But if it is, any pullback in this market should be viewed as the opportunity to look for an intra-week breakout into the 0.6600. Or if we pull back, and again, we got a nice low in this area. So we pull back and we hold this trend. Instead of breaking out, we just hold the trend, hold the trend. It's the second place next week. I'll be looking for a near-term bounce in Aussie dollar. Next is pound dollar. Huge breakout of this consolidation. Look at this momentum. Momentum precedes price. I do think we're going to have continued liquidation in the dollar, but any pullback in this market is viewed as the opportunity next week to look for bullish breakouts into the 1.2525. And if we continue to pull back and we hold the trend and we fail to break out and we hold all the way into the 1.22250, you could say, maybe retest, stair-step break of resistance, turn back, act as support. This would be the second place next week. I'd be looking for a near-term buy opportunity in pound dollar. Next is New Zealand dollar. I do think this market is probably coming back up to these highs. So any pullback next week is viewed simply as an opportunity to look for a bull flag breakout. And again, you can see we've got a kind of sideways consolidation. So I wouldn't be surprised if this came down sharply, because very often you get alternating patterns like this. If this is shallow or sideways, the next one is deep. So I wouldn't be surprised to see this come down deep. And if we break out intra-week into the prior highs over here and the 0.6080, that is where I'd be looking at booking short-term profits. And if we hold this trend and we fail to break out and we fail to break out and we just pull all the way back into the 0.590, it's the second place next week. I'll be looking for a near-term buy opportunity in New Zealand dollar. And last but not least, we have euro dollar. Now, this should continue higher if we get continued liquidation into next week. And especially if you look at the stock market that we just looked at, if we still have some further upside before we even get to the bull trap, this does suggest at least, further downside in the dollar near term. So any pullback in this market is viewed next week as the opportunity to look for bullish breakouts into the 1.0840. Wrapping up the video with gold and silver. Now, because of the sell-off in the dollar, and I am looking to be dollar short next week, especially if we're going to get continued liquidation, that does give me a de facto bias of being long in gold and silver. The only slight thing I would say to you is if we are getting a real liquidation in the dollar, a kind of pre-crisis liquidation, you can see very often in those circumstances, gold and silver really whipsaw, and in fact they can also sell off. So that is the one thing to consider. Because of that, I haven't highlighted these in gold. These are not my favorite markets, but I do have a bullish bias overall. So any pullback in gold next week is viewed as the opportunity to look for bullish breakouts intra-week into the 2030. And if we trade into the 1950 to 1955 area, and I really like this low over here, if we trade into this low as a support in this zone, this would be the area I'd be looking for a near-term buy opportunity, potentially in gold next week. And finally, we have silver. You can see silver did catch a bid at the end of the day, but any pullback in this market next week on balance is still viewed as the opportunity to look for bullish setups. And either, very much like the other markets, the two ways I'm really looking at trading these markets, either we break out intra-week before, in this case, we hit the lower bound, or we trade into, if we break out on the 1 hours, I'm looking for this into the 24 area, or if we trade into the prior low over here and also here, this would be the second place I'd look for a near-term buy opportunity in silver next week. So that is it for me for this week, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the room each day where I go through these markets and the setups that I'm personally looking at with members on a daily basis for over 75 markets in different asset classes, including stocks, bonds, Forex, and commodities.